Welcome back. You're tuned into Trading Hour here on CNBC-TV18. Well, let's focus on a couple of earnings then. Jindal Stainless SR, both of them have come out with a set of numbers currently. Both those two are listed separately. In the next few months, they're likely to get merged. So let's focus on the company as a merged entity. We have Mr. Anurag Mantri, the Group CFO, who joins us. Hi, Mr. Mantri. Always good speaking to you. Well, we wanted some guidance for the coming year. Last year has been good. On the volumes front, on your EBITDA per ton front as well. But what are the volumes numbers will you be targeting for FY23? I understand that you're expanding capacity, but bulk of that will be reflected only in your FY24 volumes. So for FY23, what is the volumes? FY24, what is the volumes? And the broad margin band that we should work with. That's the EBITDA per ton. Go ahead.
Okay. So thanks, Nigel. And as you rightly said, this expansion which we are currently doing will be coming at the fag end of this fiscal year, which is close to Feb and March. We are already running at near to our full capacities at this stage. So the volume wise over FY23 over FY22 will be more or less flat volume. So with just some marginal up, but otherwise more or less flat volume. But since our expansion will be up and running by end of this fiscal, FY24 over FY23 will be again a big jump of close to 20% of volume growth. So if I put it 2 years together, at least we can target a 12% annual growth still together, though this year will be more flattish growth. Now, on the EBITDA per ton, see, right now there's situation on the geopolitical front and various other things keeping in mind. We have, as you know, we have always given a long-term guidance of 18 to 20,000, which we are very confident irrespective of the external situation. However, currently, the run rate we are running, in the near term, we expect close to 24,000 EBITDA per ton is achievable in the near term in next quarter and so.
So near-term EBITDA per ton will be around 24,000, though on the broader range, you're looking at maintaining 18 to 20,000. Is that correct?
Yes, in the long run, we are okay irrespective of the situation which pans out because see, energy prices are increasing, geopolitical situation is uncertain, but we have a good risk mitigation strategy. We have a very wide product mix. So considering all this, we are confident of that achieving those numbers.
Okay. All right. What about your volume mix? How much of it will come in from exports? On a blended basis, you're going to do 1.7 million tons very roughly. How much of that would be from exports? Because you're facing some pressure with regard to imports. So maybe, in fact, you look at an export opportunity as well. Is there any margin difference between the two?
See, our export market, if you ask me margin difference, just export margins are higher because and it's not because of the particular product range. Unfortunately, India, we have to compete with substandard quality Chinese and Indonesian material, where obviously the margin comes under the pressure. And our export market is a very high-end export market, especially in the US, European, Germany, European Union, largest is Germany. So we get to a very high-end specialized market. It's very unfortunate, Nigel, that our quality material, we don't have a choice but to export it to these US and European market. And they are building a more sustainable infrastructure based on the high-quality material. While India, what we are encouraging after all this, we have seen only Chinese and Indonesian material which are going into the infrastructure building, which is in a long run, it is a very, very detrimental to the infrastructure building for the country. So it may be a cheaper side because these are substandard quality and not of the grades which should be ideally used in these type of things. That's the reason we are in fact, we have increased our export. Our US market export, we have tripled in last year. So, and that's actually continued to grow. Because Indian market, we really don't want to sell the product and start competing with these Chinese equipment producers at all the product, substandard product range. So considering that, our next year export mix we are targeting will be close to 30% because we don't have a choice but to increase our export mix. Unfortunate that Indian will continue to, and we expect that we have already taken up with the government strongly that the imports are coming close to 70,000 per ton almost every month. And largely out of the 2/3 imports are coming from China or Chinese producers through Indonesia, which is very, very unfortunate.
Okay, so 30% export mix is the figure that he pointed out. Mr. Mantri, good morning. Thanks a lot for joining us. This is Pavitra. I want to ask you on your debt, what is the consolidated debt going to look like? I think March of 2022, it was around 3160 crores. What is the consolidated debt on books now? And what is your cost of borrowing looking like?
So this year that is going to remain. See, we will rather continue to focus, as we have been saying, is on our balance sheet ratios, because the financial prudence is taking a front seat for us. And the capital allocation, you would have seen in the past 2 years that we gave first priority to the debt reduction and then entered into the capex phase. We are into a good debt equity and debt EBITDA position, and we'll continue to monitor of debt EBITDA of less than 1, around 1, and debt.
Okay, all right. I think they said that Mr. Mantri was mentioning that the debt is likely to hover around similar levels, but debt EBITDA, if I got that correct, is likely to be around that sub 1 odd mark. Unfortunate. I think let's try to reconnect with him. But for the time being, we have a fair bit of details. Is he back with us?
Can you hear me?
Yes, now we can hear you. You were mentioning that point, sir, that your ratios will be maintained. I think the last line we got was the debt EBITDA is likely to be maintained at sub 1.
Yeah, 1. So that's what our always target is. I have been consistently saying that we always try to maintain debt EBITDA.
Okay.
Out of 3,000 crore debt, if you see, the long-term debt has actually been reduced to only just 2,451. Last year, actually, our working capital debt has increased because the underlying raw material prices as well as our volumes have increased. So that's largely increases come from the working capital debt, not on the term debt. And the other question.
Thank you very much, sir, for joining. Thank you very much for joining in. Unfortunately, we've run out of time. We need to do a quick check on the markets.